So this we've already covered. Now what we'll do now is the next point. Okay, so we've already covered this point as to why arbitrage option valuation OVMs are not true AFV. Okay, we've already covered this point. Now what we're going to do is we're going to continue that. I want to just wrap up this discussion on models. Okay, which is the other point that we are going to do is basically we are going to do a generic FPVV. Actually, not even FPV, applies to everything. Okay, generic valuation model. Let's do a we'll call it an asset valuation, but you can value it for use it for liabilities also. Obviously, if I have lent you money, my asset is your liability, right? So when we say asset in general, unless there's a reason from the context to believe that we're only referring to assets, you can also think of it as liability valuation, because when you do this project that you do, you look at loan liabilities. Okay, so there you have to be concerned with those values also. Okay, loan liabilities also you have to be concerned about. Generic asset valuation model. Okay, so what we are going to do here is, unfortunately I haven't got my drawing tools up, it's a little difficult to do. Okay, but let's do it this way. So let's go back to this. The other thing I think what might have happened is when you studied these, you studied all these things, right? Project NPV, stocks, bonds, and all that. But I think when you studied them, you were not clear, you were not cognizant of the essential oneness of all these models. Were you cognizant of that? Cognizant means being aware of. Okay, but actually they are all the same. Okay, what we are trying to show is that these are all the same. And we are going to just introduce one, let's look at first the basic steps you are already aware of. When you have to value a project, okay, when you have to look at let's look at the stock valuation model as a thing, because then the NPV that you do, you are taking the fair value and you're also taking the cost of the project, right? Okay, so if you look at, hopefully I think I have the NPV picture here. Yeah, so here what we do is, what I want you to understand is this, that let's try to make this a little bigger. We can make it even 120, I think, because we are at 90%. Okay, so what I want you to understand, you understand now what is a forecast based fair valuation. Yes. Like when you do stocks, okay, what are you doing? Let's write down the steps here. Okay, let's write down the steps here. Later on I'll put this into a consolidated note on models, which you already have in your thing. I'll just expand that note. Okay, what are we doing? We have to value any asset. Okay, so what the point we are trying to understand is, we are trying to understand that all these things are actually the same. Okay, if you understand it that way, it becomes much easier to recall. Okay, so these are all actually the same essential formula. That's why I've said here any asset. Okay, what do we do when we have to value any asset? And remember, this can also be a liability. Okay, generic asset valuation model. Okay, so the first step is forecast returns from assets. Returns from asset. Okay, is that what? That's one step. We have to forecast the returns. This is forecast based. This is all happening in your notes. Okay, these are being written, so you don't need to write these steps, because this is being written in your notes. So anytime I'm asked to value a bond or a stock or a project, okay, or any asset, okay, if let's say there was a transaction, I think about a year back, when I think HCL Tech bought a whole bunch of licenses from IBM. Okay, they bought a bunch of licenses from IBM. So basically intellectual property. All right, how would they value that? So if you're given a problem like this, then you should not fall from the sky saying, oh, I have only done bonds and stocks and projects, I don't know how to value this. You can value any asset using the same generic principles. Is this clear? So you should not fall from the sky. If you see a problem like this, how should HCL value what price did HCL pay? What should they pay for these IBM licenses? Okay, how would you? And so that is connected to the fair value. Obviously, if they feel the fair value of those licenses is $100 million, then they should ideally pay a little bit less than that, right? Yes, you agree? Yeah. If the fair value according to you is 100 million, you should not be paying 120 million for that, right? You should be paying a little less so that you can capture that surplus, right? So how would you value? So therefore you have to first come up with a fair value for those licenses. So the point here is that any asset valuation, there's a very generic formula, forecast returns from asset. Okay, first forecast return from asset, well, let's make it very clear, and we call it period wise. Okay, or we can just call it periodic, smaller word. Periodic returns, this is meant to just show you that we are talking about year 1, year 2, year 3, and year 5. That's what it means, okay? Periodic means, basically it should be period wise, but I'm just using a shorter word. So this is meant to show that in every period that you're forecasting, okay, it's quarterly, and usually we take it to 1 year period. Okay, so you're forecasting the returns, which is over here, right? So many people in the exams also have written cash flows. That may not always be true. Okay, in the case of in this particular case, project cash flows may be true, but it's always better to use a general word like returns. So if you say returns, it covers everything. It covers earnings, it covers dividends, it covers IBM licenses, revenue from IBM licenses that HCL Tech will earn. Everything is covered under returns from the asset. Okay, so that's a general expression. All right, so you forecast these. Okay, and what is the next step? Someone can tell me?
Discount.
Yeah, so discount, so this is over here actually. Okay, so then basically PV the, okay, using appropriate, or I'm not going to use such a big word, proper. I'm just going to say proper for appropriate. Actually, it should be appropriate. Using proper discount rate. This is clear? Yeah. Now, discount rate could be cost of debt, it could be cost of equity, it could be your WACC, depends on what you're discounting. Okay? So again, I'm using a general term. I'm not using, cost of equity, because that would be too specific. It may not apply in all situations. If I use a general term like discount rate, it applies in all situations. Yes? Rajan, you're following? Okay. So using proper discount rate, this is your second thing that you're doing, using proper discount rate. All right. So second step that gets you here. So you've now done this. You've got the periodic returns and you have discounted it. Yes. Okay. And then obviously the last one, very obvious. Add PVs. Okay. Add PVs to get total fair value using FBV methods. Okay, is this clear? All right. So actually, this is in this case, we are talking about for FBV. You understand is for forecast-based valuation. Okay. Yes. But we are going to actually be able to apply it even in an option valuation situation, even in AFB situation. So we'll make this a very generic model. At the moment, we are just, for your familiarity, we are discussing it with respect to, so I'm not going to use this FPV method here. Okay, this will go here actually. Okay, let's put it actually, I want to make this, because this is a very generic model. I'm just going to keep it here so that we don't write. Are you following so far? We are just trying to understand the general principles. Okay, make sure we understand that everything that you've done is application of general principles. Using proper discount, add PVs to get total fair value. Is this clear? Yes. So therefore, in the NPV calculation that you do for a project normally, this part, leaving out the C0, the other terms, the sum of the other terms is the fair value of the project. Yes, you understand? Everybody normally thinks straight away you go to NPV, you don't see the components of it, right? So the part other than the cost of the project is the returns from the project, is the fair value of the project. Yes. Okay. So therefore, what you have got is then your NPV is a specific calculation that you're doing with respect to this. But it's important to understand that the fair value of the project is contained here in these. Okay. So now we are going to just introduce one more twist. Okay. In this, all we are going to do is in this forecasting. So you've got this. So this is a general. So let's first see this point, that in all these examples that you have done, okay, project. If you just look at the calculation of the fair value of the project, and the NPV is just the difference between the cost of the project and the fair value of the project. Yes? You can see here. So you may be a little bit confused. You say that when we did projects, we did NPV, we did not do fair value. Okay, but actually all you're doing is you're just comparing the fair value of the project here with the cost of the project and coming out with a new metric called NPV. Is this clear? Yeah. Okay. So that the first point we want to establish is that there is a generic formula that you are using, which all of you are familiar with, that you're forecasting the returns for, whether you're looking at project valuation. So you can look at the fair value of the project. NPV is just a transformation used on that, using the cost of the project as an additional factor. Okay. IRR of the project also is basically involves the fair value of the project. Okay. So we'll come to that. Let's look at that as well. What you're doing in IRR is. Okay, first let's understand this. So when you're doing stocks also, when you're doing the Gordon growth model, are you not doing the same thing? You are forecasting these things become the dividends. Yeah, these things become the dividends, and actually what you remember from the Gordon growth model, which is R minus G, or simply by R if there is a constant dividend model. Okay, but that actually is just a convergence of a that is actually just the limit, that formula that you remember. I hope you guys understand this, that formula that you remember from the Gordon growth model is just the limit of a convergent infinite series. You remember infinite series?
Yes, sir.
From APGP and all that? Yeah. So there are two. There could be a divergent series or it could be a convergent series. Okay. In this case, this what you do in the Gordon growth model is, that's why is a convergent infinite series. So the limit of that is R minus G or R. Okay, when it's a constant dividend situation. Okay, so that's how you come up with the formula. Okay, so but actually when you write out the Gordon growth model in the initial step, that final formula that you remember, okay, I'm sorry I don't have that picture here with me, but the point is that are you guys following what I'm saying?
Yes, sir.
You remember the Gordon growth model?
Yes, sir.
Where you take the dividends, okay, and you write the formula that you write is, if it's a constant dividend, then it's D by R, right? So the fair value of the stock is D by R, and if it's not a formal, it's not, if it's a there is a growth rate in the dividends, then it's D by R minus G. Okay, so how did that formula come? How did those formulae come to be? They came from this same kind of expression. You predicted the future dividends, okay, using the growth rate. You predicted the future dividends, so you had D0 into 1 plus G, D0 into 1 plus G square plus 1 plus G cube, etc., etc. in each of the years. Then you discounted them with these kind of discounts, and that became a convergent infinite series. Because it's a stock valuation, there is no maturity. Stocks have no maturity. So it's a convergent infinite series, and the limit of that comes out to be R, D by R or D by R minus G. Are you following here? Yes. Has everyone followed what I've said? Yes. So that even in the Gordon growth model, actually this same rule applies. What we have just laid out here. Is this clear? To predict the returns, discount the returns, and to arrive at the PV by PV of each return, then sum the PVs. Is this clear? Same method is being applied in the Gordon growth model. So we have established that there is a general formula. We are applying for stocks, we are applying for projects, even for bonds. What were you doing in the case of bonds? Let me see if we have anything here. Do I have these formulae? Are actually very difficult to write because these, you have to use these equations. Okay, so this is not here. Anyway, so you remember the formula for bonds? Okay, it's pretty much the same thing if we go back and use the same old NPV, project NPV. Again, and what are you doing in the case of bonds? If you want to calculate the fair value of the bond, okay, you are computing, basically you are predicting the returns from the bond, which is the coupon returns, and in the last period you have the principal, okay, and that is called a bullet repayment of principal, okay. Then the principal is repaid at maturity, that's called a bullet repayment. So these terms also you should learn. We should put them down here if we since we are discussing them. Principal repayment can be either bullet repayment means it's a one-shot repayment at the end. Okay, so these terms you should understand, especially Chug, who is going into bond analysis. Bullet or amortizing, everybody should understand this. Bullet or amortizing, is this clear? Yes? Okay, so amortizing, you understand, when you do student loans, housing loans, those EMIs that you are paying every day, every month, okay, those EMIs contain not just interest but also some principal pay down, right? So that kind of system is called amortizing principal. Okay, so that is called, when you do swaps and things like that, these terms become important because you have to understand how the principal is going to be repaid. Okay, is it a bullet repayment or is it an amortizing repayment? Okay, all right. So this is just a side point that we are discussing. Since we have discussed it, we have put it in here. So we are talking about the general asset valuation model here. All right. So in the case of bonds, also we do the same exact thing. We predict the coupon returns from the bond, and in the case of a bullet repayment, last term is C plus P. Yeah, coupon plus principal payment, and then again what we are doing is we are discounting it. Okay, adding compute the PV of each return and then adding the PVs, coming up with the fair value of the bond. Is everyone clear? So the first thing that we want to understand clearly here in this class, the first point we have discussed is that using this general principle, okay, the general asset valuation model, we can value all of these things, that they are actually all the same. They are not different. Okay, they're all the same. All right, now let's look at some twists here, which we are going to also use to discuss unfortunately I can't copy this and I don't have the picture here, so we'll have to do this. Now what are we going to discuss? The second point, I gave you a question. Is everyone following so far? Okay, now let me before I go to the next point, let me introduce a second point here, which is 1.1. Alright, now we are going to introduce a second, we'll make it even more generic so we can apply it even to the option valuation model. So we can apply it to any model. We can apply it to any of these models. Okay, all of these models are basically using the same exact principle. In this periodic returns, normally when we forecast, how have we done it? We have just picked a number out of the hat. That I think when you're doing project returns, okay, maybe you followed some method, but what you did was in your spreadsheet model, you just put in this return directly. You thought the first year's return is going to be $150 million, so you put in 150 here. Then you put in, maybe next year's return will be 230, so you put 230 million here, so on and so on. Directly you put it in. Okay. Now I'm saying that let's introduce a little twist. Okay. That forecast returns, we are going to introduce a little twist, okay, which will make the model so generic that it can be applied even for option valuation models, because even option valuation models are essentially doing the same thing by looking at the along with the synthetic equivalent principle, but we make the model more generic. Now we are going to say that as expected values. Okay, you understand the term expected value? This is the same as mathematical expectation. So in statistics we use the term mathematical expectation. Okay, but in finance we either say expected value or we say expectation directly. Okay, so have you come across these terms? Expectation of X. In stats also you write it as expectation of X, capital E, bracket X. Expectation of X, which is nothing but summation PIXI. Yes? Yes? Same as mathematical expectation. Everybody is familiar with this concept? Yes. No doubts? Okay. So now what we are saying is, now because you know what you have done in the past, you have directly entered the forecast. Like let's say these are project returns. If your forecast for the first year's return was, you thought that whatever you came through some process, and you directly put in a number saying 230 million in the first year, 500 million in the next year, and so on and so on. That's what you've done, right? So in your spreadsheet you have entered, let's say, where are we going to put this? We can put it here itself. So in your spreadsheet you would have directly entered, let's say 120 million, I'm just talking in millions, say 245 million in the next year, okay, 320 million in the next year, and so on and so forth, right? Can you see the numbers? Is it too small? Shivam, can you read the numbers? Yes, sir. Yeah? Okay, so this is what you have done in the past when you were doing your project returns. Okay, you just directly put in some numbers, okay, based on whatever process you went through. Now I'm saying let's introduce a little tweak. Let's not introduce the numbers, let's not put in the numbers directly. Let's put in the numbers indirectly by writing the numbers as mathematical expectations. Okay, so here's what I'm going to do then. What I will do is, now I don't know these numbers. Okay, what I'm going to do, let's say I don't know this 120. Now it may end up being something else, but we'll have to create, I'll just show you for the one. So I had 120 here. Okay, now it may not come out as 120. Instead of writing 120, what I'm going to do is, let me take this a little bit lower down. Okay, so this is say year 2, okay, and this is year 3, all right, and here we have year 1. All right. So what I'm saying is, now let's not write this what you're used to, which is just to write it as directly writing the numbers, but I'm saying let's use it as let's write them as mathematical expectations. So what I'm going to say is, instead of when I think about the first year's return, okay, I'm not going to think directly coming to 120. I will say that in the first year, let's say I'll just write, let's say there's a 30% chance that we will make say 95 million. Okay, then there is a 40% chance that we'll make 200 million, and then there is a let's just make it simple, and let's split it further. Let's say the 15% chance. Then we have to move this a little bit. Okay, and then we have let's make it 10%, and let's make it 20%. Okay, so we check that our probabilities add up to 100. Okay, they add up to 100. We make this probabilities. All right, and then we say there's a 10% chance of earning, let's say 400 million. I'm just putting arbitrary numbers. Okay, and then there's a 20% chance of earning 150 million. Okay, are you following what I'm doing? So when I'm thinking about the first year's return, instead of directly coming up with a number, I'm splitting up my decision making process further by saying that the first year's return, I'm not going to forecast it directly, but I am going to think probabilistically about the first year's return distribution, the distribution of the first year's return. Is this clear? That we are saying that according to me, there's a 30% chance that the first year's return will be 95. There's a 40% chance that it will be 200. There's a 10% chance that it will be 400, and then there's a 20% chance that it's 180. Is this clear? So now then, my first year's forecast of return has to be well, let's just say we'll make it okay, let's just compute this. Right. And so basically this becomes sum of this. Has everyone followed what I've done? Okay, so my first year's cash flow forecast is now 178.5. First year's return forecast is 178.5. I did not directly come up with this number. As you can see, I had no clue what it was going to be, but I was quite sure that there was a 30% chance it would be 95, and so on and so forth. Is this clear? So now I'm introducing another tweak into your generic asset valuation model. The earlier steps you were all familiar with anyway, and you're also familiar with the concept of mathematical expectation, so that we are not introducing any new concept as such. Okay, all we are doing is we are combining two concepts, and we are saying now, don't forecast the periodic returns directly, but forecast them as expected values. Okay, this is also called expected value. So this thing that we did, okay, this thing that we did here is, it can be called the mathematical expectation of the first year's return, it can be called the expectation of the first year's return, or it can also be called the expected value of the first year's return. All these three, so you should also be familiar with the language, what kind of expressions are used to describe the same thing. Okay, all of these mean the same thing. So here obviously expected does not mean that I expect that it will rain tomorrow. It's not being used, the word expected is not being used in that sense. Okay, it's being used in the sense of statistical mathematical expectation. Is this clear? Okay, so now have you understood what tweak we have introduced? Okay, so if you remember this, and if you do, anytime you do a project valuation, or anytime you're forecasting returns from some distressed credits, like where you may be working on distressed credits, okay, where you're trying to figure out the cash flows of a slightly company in financial difficulties. Okay, so even there, I think this process is much better to forecast the returns when you're taking the fair value of the bond. Okay, don't forecast it directly, but think probabilistically. That makes your thinking much more granular, and later on, when there's some change in the circumstances, what you do is you adjust the probability distribution here. You never tweak this directly. If you think there's some changes here, things have become, the environment has become much more rosy, there's a massive tax cut from the government, okay, so then what you do is this probability of a low return, 30%, this you can reduce to maybe make it 10%, let's say 15%, okay, and then you can make this as 55%. Yes? Are you following what I did? Because there was a massive tax cut from the government, so you have updated your returns expectations because the economy is going to boom. All right, so now you see that number has gone from 170 to 194, but this is a much more rigorous process, okay, because it forces you to think in these probabilities, okay, so it makes your thinking more granular. So this is a much better discipline to follow. All right, so you've followed this now. Now if you can remember this generic asset valuation model as we have modified it here to forecast the returns as expected values, that's it basically. It covers all, and once you come, it covers all of this stream, okay, it covers all of this side of the framework, and it also covers all of this with the additional concept of the synthetic equivalent, which you have also understood. Okay, so they're basically going to predict where you have certain, because sometimes you may have forward rates. You may be selling when you're computing the synthetic equivalent, okay, you may be selling something at a forward rate, okay, so then you will have, especially in the case of option valuation, this becomes more important. Okay, so this really is more important for forecast based valuation and option valuation models. What will happen in the case of if you have this kind of a, where everything is locked in, okay, where everything is locked in, let me go back here. Okay, here we were practicing, please pay attention, these are all important concepts, you better make sure that you understand everything that is being discussed. Okay, here we are predicting the returns from a project. Yes, okay, so therefore now you understand how this generic formula can be applied in all situations. Okay, once we have modified it to do expected returns. Okay, it will apply in all situations, it will apply here, it will apply here, okay, and it will apply especially in options, and even here it will apply. How? We'll show you, because we said on this branch, what do we have? We have pure classical riskless arbitrage, pure arbitrage free valuation, there is no forecast. Okay, so then you might ask this question, so if there is no forecast involved, everything is seen, everything is clear to me 100% in front, I can lock in all the prices, then what will I do with the probabilities? Okay, so then comes the question, you see how probability is a flexible concept. Okay, right now why do I have all these probabilities? Because these are project returns, I don't know what's going to happen, right? I'm thinking of I don't know what's going to happen, because so that's why I have to think in terms of probabilities, right? Because it's uncertain, right? But if I have, let's say that if I know for sure that I will get a 200 return, but I will get it after 5 years, the forward price is available to me, I've locked in the return, I'll get it after 5 years. Okay, so in this case, if I'm sure about the 200, then what happens to this distribution? What is the probability of a certain event? 1. Yeah, so here then what will happen is, I'll just write all of these will become 0, this will become 0, this will become 0, and this will become 100. How will that also become 0? This will become, now I've got 200. Can you see what is happening? So therefore this general model, this general principle, this general asset valuation model can be applied for all valuation situations. Whether you have pure classical riskless arbitrage where everything is locked in, you may have locked in a forward price where the settlement of the deal will happen after 5 years. Okay, but the thing is that you can discount that return. Only thing you will do is you're still applying. So what you have to understand is you're not, even in this situation, even in a situation where your return of 200 is guaranteed, okay, you are actually not writing to 200 directly, because you're always following the general principle, the general formula. So you're not writing 200 directly. What you're writing is 200 into 1. Are you following? Right? So that discipline should be maintained, so your thinking will remain clear. That you're applying, because if you just write 200 directly, it may seem to you that if you just like 200 directly, then it may seem to you that well, this general formula with expected returns is being applied only here and only here, but is not being applied here. Are you following what I'm saying? Right? But actually that's not true. Even in the situation where everything is guaranteed, all prices are locked in, okay, even there the formula, the same framework is being applied, but only that you're writing it as 200 into 1. So you're still using expected value. Are you following? Right? Even when the return is guaranteed. So when you're forecasting returns like in bonds, when you're forecasting returns from local currency government bonds, okay, so local currency government bonds are virtually guaranteed to pay out. There's no risk. Okay, the one exception to that is the Russian default of 1997. Okay, I don't know if it's 97 or 98, but the one which came with this, I think it was 97. So the Russian government defaulted on ruble bonds. which they need not have done because the Russian central bank could have just printed rubles and paid off the money. But the Russian government defaulted on ruble-denominated bonds, which was a very unusual event and caused a lot of disruption in the global financial markets. It led to the collapse of a major fund called Long-Term Capital Management. You can read it up, LTCM and the Russian crisis. Okay, so that's the one example that I know. There may be some other examples in history, but in general, local currency government bonds in a fiat currency regime are risk-free. Okay, let's write this principle also. Let's write this concept. You understand what a fiat currency? So this is another concept that we are discussing. Okay, this is our third concept that we are discussing. Generic asset valuation models. This is our third concept. This is actually the first, but we have introduced. So this is a different topic. So it's got a different star on it. Now we are discussing the concept of credit risk. Okay, credit risk in government bonds. Okay, this is our second topic that we are second side topic that we are discussing. Is everyone following the discussion here? Right? So credit risk in government bonds. So the general expression that we may write, the general thing is, you understand what is a fiat currency regime? So in India we have a fiat. You understand what a fiat is? Not a car.
That's what fiat is a car.
Fate. No. Fade. Fake. No. Fiat means order of a it's like an order of a sovereign. Okay. This is say Chandragupta's fiat. So that means he has given this order. Okay. So fiat means it's an order of a sovereign. Okay. So it's of somebody with a lot of power. Okay, so when you can say these mullahs issued a fatwa against Salman Rushdie, that is also a fatwa can also be seen as a fiat. Okay, if it's coming from a sufficiently powerful person. So fiat, as in spelled in fiat, F-I-A-T, fiat, like the car. Okay, but fiat means the order of a sovereign. Okay, so basically in India also we have a fiat currency. Why do we accept these 10 rupee, 20 rupee notes? Because the Reserve Bank says that this is legal tender. Okay, the Reserve Bank is representing the government. So India also has, most of the modern countries have fiat currency regimes. Okay, basically the money is there, is paper money, and why do people even give it any value? Because the government says that this money is legal tender. This is clear? Okay, so that is what is meant by a fiat currency regime. I'm not writing this long explanation, but you can remember this. Okay, so fiat currency regime. So what we say is that so generally, okay, so you should understand all this. Generally, so we are talking about credit risk in government bonds. Why is this topic important? Because we are talking about applying the generic asset valuation formula even to bonds. Okay, so while having that discussion, I think it's useful to discuss this point. Okay, so generally, is everyone following? Some of the faces are looking a little doped out. Are you okay? Are you following?
Yes.
Okay. If you don't follow, it's your job to ask. Okay. Sometimes I see people, then I ask them, looking at their face, and then it emerges that they have not followed. Okay, but I can't keep doing that all the time.
For example, yes.
For example, yes. No, but Yash is asking questions. The for example will be Gulati.
Yes, sir.
For example is Gulati, who is not following and not. That day we caught you. You were not following and you were not asking. So Yash is normally he asks questions. SG1 is Mr. Bindas. So we expect him to be relaxed. Okay. So generally the principle that we are talking about is generally local currency. I'm writing CCY for currency. Okay. Local currency government bonds. Please pay attention. I'm hearing noises, people talking. Local currency government bonds in a fiat currency regime. So India, we say India, Australia, UK, Canada, they all have fiat currency regimes. US, any country, because the money is paper money. The only reason it has value is because the central bank on behalf of the government says this is legal tender worth so many rupees. Okay, so that's a fiat currency regime. Local currency government bonds in a fiat currency regime are risk free. I mean, as basically free of credit risk, not free of market risk, free of credit risk. You understand the difference?
Yes, sir.
Okay, free of credit risk means there's no chance that the government will not pay the coupon or the principal. Okay, no chance of default. Okay, are free of credit risk. Okay, generally. Why did I say generally? Because there is an exception, very important exception, which is the Russian default of, you can check it up. If you look at it in connection with LTCM, you'll get the exact year, whether it happened in 97 or 98. Exception is the Russian sovereign default. You understand what is a sovereign default? Sovereign default means the government defaults on its own bonds. Okay, so Russian sovereign, I'm not spelling it correctly, Russian sovereign default of 1997. Okay, why is this an exception? Because obviously you know that the Russian government defaulted on ruble bonds. Okay, so I'm not going to write that here. Is this clear? Because I'm talking about this as an exception to the general principle of local currency debt being free of thing. But go and capture Garvit also and bring him. Go with a net or something, you know, like capture him and bring him back. No, here one person has already gone. Okay. The Russian sovereign default of 1997, okay, LTCM collapse. LTCM is long-term capital management, so that also I'm not writing. You should remember that. It's a famous fund. You can read up on it. Okay, you can search YouTube as well. You'll get some information. You'll learn about certain things. Okay, what happens to highly leveraged entities? Okay, this is a quantitative fund that collapsed. So long-term LTCM stands for long-term capital manager. I'm not writing all that. You can Google this stuff. Okay, and the related LTCM collapse. The Russian default led to a global market disruption and eventually the collapse of LTCM. Okay, so this is a general principle that we have learned. Now you understood this principle. Local currency government bonds are generally risk-free. So why did I come to the concept of risk-free, free of credit risk? Because we were talking about applying this generic formula, okay, where we have expected returns, okay, we have applying it. So when you are applying it, even in the case of government bonds, okay, there's no risk. In the case of local currency government bonds, there's no risk of default. So the $200 that is going to be paid after 1 year there's no need to write it with the probability, but you still use the same expression. So you write 200 with 100% probability. Is this clear? Is everyone following? Yeah.
So you're basically saying that the bonds which are issued by the government are free of credit risk.
Yeah. As a general principle, local currency, because why do you understand why? Did you understand why? Because it basically it is much easier politically from the government, and I'm not writing the democracy part, say most of the countries are democracies, okay? Because think about it, if the government of India defaults on bonds, okay? If the government of India defaults on its bonds, okay, it's quite a it's a major PR disaster, okay. Then maybe some government, a lot of pension funds are invested in government bonds, okay. Maybe some retail investors have invested in debt funds which invest in government bonds. So all those funds will go bankrupt if the government of India defaults. So which government is going to take all this PR heat in a democracy? Because next time they'll lose the election. Okay, what is much easier for the government to do? The RBI can print money at the government's direction. So if some amount of money has to be paid, say $100 million has to be paid, why are you going out now? He has already gone.
Yeah.
No, you wait for him to come back. No, wait for Yash to come back. We have a rule now. Garvit has already violated that rule. So I have to penalize him actually I'm going to penalize him today on marks, because he's not following the instructions. Okay, now I don't have time. I do all this policing. I'm going to police, or am I going to teach? Okay, now are you guys following what is being discussed here? We are discussing the principle of why local currency sovereign debt is generally considered to be free of credit risk, because in most countries which are democracies, if the government defaults on its bonds, it's a major, of course they could do it in Russia because at the time it was not a democracy. Even now there are some question marks about democracy. So the government held a lot of power, so they didn't really care about what the people thought, right? But in most countries, can you imagine in India government defaulting on its bonds? It's not going to do that because the political cost is too high. Much easier for the government to tell RBI, go print some money and pay these bonds. Are you following? If there's not enough, when do you default? When there's not enough money to pay the bonds, right? So instead of doing that, you just tell the Reserve Bank, go and print some money and pay these bonds. Are you following what I'm saying?
So Reserve Bank cannot print as many money.
No, Reserve Bank can, actually the Reserve Bank is I think required under law to buy any excess, but it will not happen exactly like that. It will happen, the government will issue bonds and the Reserve Bank will be forced to buy them. But how is it going to buy them? Where is it going to get the money from? It will print more money. The Reserve Bank can print unlimited amounts of money. That it will actually, the process by which will happen is the government will issue bonds and the Reserve Bank will buy them. Okay, and where will they buy? How will they buy it? Where's the money coming from? They are printing money. Okay, because money is what the Reserve Bank says it is, right? So they can. That's called expanding the money supply. The Reserve Bank has the power to expand. You've run your macroeconomics, M1, M2, and all that stuff. Okay, broad money and all these concepts. Okay, so you can expand the monetary base. The Reserve Bank can expand the monetary base, right? They can pump money into the system, right? So therefore, the point, that's why we say this, we have spent a lot of time on this principle, but it's still important to understand why this is true. That in most countries, the government would rather, because it's a fiat, that's why this word fiat currency regime has been put in. Why did I say fiat currency regime? To accompany this principle that local currency government bonds are generally free of credit risk. Why did I add this qualifier, fiat currency regime? Because in a fiat currency regime, the central bank can expand the money supply, because the money is what it says it is. If you have a gold standard, you understand gold standard? Gold standard, where you have to, your amount of money in the economy is backed by gold. There needs to be a ratio maintained. If you want to increase the money supply, you need more gold. Okay, so that's why I didn't say gold standard. I said fiat currency regime. Fiat currency regime is different from a gold standard. In a gold standard, there is a central bank does not have the control over the money supply, because if you want to increase, you need to increase the gold supply. Are you clear? Is everyone following? Okay, we are just following a general, we are just expanding on a general term. Yes, Garvit, we are going to penalize you today because you have taken a long time. Every day you are going out.
Sir, I have lost my car key, sir. I was searching for that, sir.
That you search after class. You search after class. Why are you searching during the class? Yeah, no, but Yash is not now. Somebody else went out. Who went out? Yash has gone.
Yes.
Kanika has also gone out. Everybody has gone out. 1 minute, let Yash come back. Yash has not come back. So I don't know why Yash also went out. Somebody has to monitor this. Gulati, can you monitor this? Make sure that not more than one person goes out at a time. Okay. So we are just discussing that we have spent a lot of time on this topic, but these are all important concepts which you need to understand. Okay. Fiat currency regime. Are you able to follow why I am saying this? That in most countries the government, where is she going now?
Sir, my number.
Your phone, no, you keep your phone now. Your phone is supposed to be switched off.
Sir, it's my turn.
It's important.
No, you sit here and okay, you go out. Come back quickly. This phone business is all every call is urgent. Then every call that is coming is urgent. You have to keep your phone on. You have to switch on the phone only within. I mean, there have to be some other people at home who can take care of a problem. No. Then okay. So the point I'm trying to emphasize, has everyone understood? I'm just giving you a detailed discussion of this problem, but it's still an important point that you should understand. That it's much easier for the government to just print money and take care of the bond payment. Okay, and the way the printing money happens is the central bank prints the money and buys the government bonds. The government will issue more bonds to pay the maturing bonds. That's what will happen. The government will issue more bonds to pay the maturing bonds, and the RBI is actually required to buy any residual government bonds which are not sold in the market. The Reserve Bank has to buy them. Okay, and they will buy it by effectively when they buy the money, they will when they buy the bonds, they'll have to sell money, and they will produce the money and sell it to the government. Is this clear? Yes, Pulkit.
I was asking that if RBI continues to print more on the order of government, then our currency will lose its value.
So what do you think is happening in Indian rupees? when we started out, the Indian rupee was, I think 40, I don't know what it was, maybe it was much lower, it was maybe 35, 40 or something. And why do you think this has been happening? Why do you think the rupee is now at 70? When you look at the Singapore dollar, when you look at the Japanese yen from the 1970s onwards, they have appreciated against the US dollar. The Singapore dollar is appreciated against the US dollar. Okay, if you look at a chart, like if you look at any chart, we're not going to go into that right now, but you have those links. I've given you that FX top. If you look at this, okay, I don't know if this may also be blocked. No, it's working. Okay. So just to come to Pulkit's question is correct. We are going to change this to US dollar, and we are going to make this is a very useful site for where is India? Now you see, I can't see the scale. All right, but let's go down and see the sale. I got it. Yeah. Okay. Where is it now? So it was 10. So it is actually 4.76 is the low in 1965. Can you see that? Yeah? Can you guys see that? 1965 approximately, 4.76 is the low. You can't see the 4.76, but here now you can see 4.76. Yes? Right? So Pulkit's question, yeah, it's a very good question. That is what is happening. What is happening here? Law of supply and demand. Excess supply, what happens to the price? When you have excess supply, price will fall. So what is happening here is basically the price of Indian rupee is falling. So this chart is dollars. So the dollar value is rising. That's what you're seeing. So what you're seeing here, why this rupee is like this? Because of mismanagement, fiscal mismanagement, nothing other than fiscal mismanagement. Sheer bad policies. There's nothing that we were not fated to become like this. We were not fated, just pure bad policy management. You want to see something else? You want to see, let's say, what happens with good policy management in a country which has no resources. Okay. Singapore, where is Singapore? No resources, country with no resources. Okay, no resources, pretty much an uneducated population from 1963 to 2015. Can you see the difference? This is dollar as base asset. In the one case, the dollar has appreciated so much, gone from 4 to 75, 70, 72, okay? And in the one case, the dollar has fallen. Singapore became independent in 1965. So, 1965 here. So you can see, it was around 3.06. When Singapore became independent in 1965, it was around 3.06, and now you see where the dollar is, okay? It's around 1.35 or something like that, okay? So it is more than halved. The dollar is more than halved in value. Okay, what is this? This is a country with a tiny country with no resources, no oil, nothing, no gas, no coal, nothing, just good management. All that financial stuff has come from good management. Open markets. Singapore is the most open economy in the world. Okay, you understand how you know how you measure? Have you heard this term, open economy? Which is the most open economy in the world? Yeah. How do they come? Very good. So how do they come up with this answer? How do we come up with this answer? Okay, we say that Gulati is the tallest. How? Because we have the height. We use we are measuring the height. Okay. So how do we measure openness of an economy?
Ease of access.
1 minute. Another side point that we have to learn. Another side point. 1 minute. Let me make sure that we have the side points documented. Are you following what is being done here? All side points are being documented separately so that you understand these are all important points. Okay, since we are discussing this, we have deviated a little bit. Okay, are you guys disturbed by the way that sometimes we drift across to other things? Does that disturb you? Okay, because these are not planned. These are not planned. I didn't have a plan. I had a separate plan, but now we are just diverging because based on the questions. Okay, so we are responding to the questions and expanding the scope of the discussion, which is what I believe should be done, because the whole point of coming to class is to ask questions. So the focus of the class has to be to answer the questions in a proper way. Okay, what are we discussing? Open economy. Okay, how do we discuss open economy? Okay, how do you discuss the openness of an economy? Okay, openness of an economy equals, okay, you didn't know this measure, I guess. Exports plus imports divided by what? Use your common sense. Okay. Now understand this. This is the way you measure. This is the way you measure the openness of an economy. So for every country you can, because obviously if you want to measure, if you want to say which is the most open economy, you have to have a measure of openness of an economy. Okay, it could be openness or closeness, whatever you want to see, half full or half empty. So the measure that you use is this. Okay, export plus imports by GDP. If you use this, you will see that Singapore has the higher this is, the more open the economy is. So Singapore has a very, very open economy. Okay, very low tariffs. Okay, so that's how they become prosperous, and they had by and large no capital controls from the very beginning. If I can remember, no capital controls. So a Singaporean person, see in India, as I told you, Okay, if Roger Federer were an Indian and he had $1 billion worth of wealth and he suddenly decided one fine day, no, I don't like the rupee, I want to move everything into Canadian dollars, he can't do that. There are certain limits the RBI places on how much money you can take out of the country in a given year. Okay, right now it's around 750 to 1 million legally. Okay, but in Singapore there are no controls. Okay, so if a Singaporean billionaire wants to move all his money, sell Singapore dollars and buy Australian dollars, there's no restriction. Okay, so you can see all the prosperous countries, you can see what it does to the currency, how strong the currency is, and inflation in Singapore is very low. In India, we have a very big problem with inflation until recently. Now with the new framework, we are able to control it a little bit. Okay, but we've had a big problem with inflation. Part of the reason for the currency depreciation is also the inflation. Okay, and the inflation is also connected to the point that Pulkit raised: expansion of money supply. You heard the expression called too much money chasing too few goods. Inflation is caused by too much money chasing too few goods. Okay, so that's the monetarist view of inflation. So this is actually true to a great extent, that if you have a fixed amount of goods and you print too much money, the price of each unit of the good will go up because everybody now has more money in their hands. Yeah. Okay, so this is a long discussion, long answer to Pulkit's question. But are you okay with the answer? You understood? So what has happened? What you predicted has actually happened. You saw that in the case of the Indian rupee, and you can also see what happens when you have, good economic management. Okay, openness of an economy. I'll just put the link over here. So put SG, we discussed Singapore as the most open economy in the world, and I'm putting the link here for the Singapore dollar. You can experiment with the rupee as well on that chart. Okay, all right guys, so let's go back to our point. So we have diverted a little bit, but these are all relevant discussions emanating from the questions. Okay, so a contrast to so we go back to our asset valuation discussion. What is the point that we were trying to establish? That you can use this general framework with expected returns to value any asset. So when you're valuing government bonds, you would simply say that the returns in each year are basically, instead of writing 200 directly, you're going to write it as 1 into 200. Is this clear? Because you're using the same framework. Okay, and if you look at all option valuation models, we will not be discussing them in detail, but essentially what all option valuation models do is essentially the same thing. Okay, they are looking at the expectation of the return, they're forecasting the returns. Okay, it becomes very clear when you see the binomial model, visually becomes very clear. Okay, but they're following the same general principle. Okay, and they're looking at the present value of the returns and compare using the synthetic evaluation, synthetic equivalent concept also. And so if you use this general principle, so the point that we are trying to make here is, perhaps we took a long time making the point, that all these asset valuation models have a commonality. Okay, basically that is involved. That involves the forecast of the expected returns. Now we are no longer saying forecast of returns. We are saying forecast of expected returns because we have expanded the framework. Yeah. So forecast of expected returns, discount it, and just add the PVs of all the individual returns. This is clear. Okay. So we spent a lot of time, but did you get some extra clarity?
Yes.
Hopefully, because we have actually discussed all the stuff that you guys have already done. But we have tried to show that all the methods are actually the same. So you should think of it as application of a general principle across all these cases. Okay, that helps you to remember it better. Okay, so we have covered this. Now we have one more point left to cover. Okay, within the concept of valuation, I think we have one important point left to cover, and that is we have two more important points to cover. Okay, which is this. Okay, now remember that I also said that this is falling under the price versus fair value comparison method. All these things are falling under this umbrella. Okay, so in this umbrella, what do? You compute the fair value, which we have here. We have something here. No, I think this is in your okay, we have this. Yeah. So in all these in these models, in this set of frameworks, okay, when we go back to this, all these, since this is falling under this, and everything that falls under this, what is the general framework that we are using? We are using this general framework of that we calculate the fair value. We calculate the fair value. I'm just going to copy this once again, okay, and put it into your notes at this point, okay. That here we are using this these steps, okay. Right? These are the steps we are following. Now I'm trying to show you why this framework is correct, okay. Now you might question this, where in the project NPV system, where do we do this, right? Are you following what question I'm asking? Because I have put this under this umbrella, right? And I have said that everything under this umbrella basically involves this kind of thinking, which is calculate the fair value. These are the steps. Calculate the fair value, observe the market price, compare the market price to the fair value. If the market price is below the fair value, then buy. If the market price above the fair value, then sell. This framework also has to be clearly understood, although it may be very obvious to you, but always think like you're talking to a computer, okay. So now you may ask this question, now where in this project valuation scheme, where is this applied? How is this applicable? Because I put the projects also under this umbrella. That means in project valuation also we are doing the same thing. Okay, so the question you might ask is, where is this happening in the case of the project? Please explain. Okay, so let's go back to the project where we can see this. All right, let's look at this now. See, we already understood that in the case of the project, this is the fair value of the project, this component. Yes? Are you guys following? This was the fair value of the project. Now what is this C0 that we are adding here? Initial investment. So can we call it the market price of the project? Everyone be convinced that can we call it the market price of the project? Yes, Tarun? Is it okay to call it the market price of the project? Because this cost is, we normally call it the cost of the project. Okay, you might say that cost is not the same as market price, but this, understand cost for whom. Let's say the Delhi Metro wants to expand the network to Karnal, okay, and L&T Construction gives a bid of say $100 million. Okay, so for 100 million they will execute the project and extend the metro to Karnal. Okay, now this 100, when L&T Construction is bidding 100 million, do you think the cost of it for L&T Construction to make the project is 100 million? It's got to be something less. They have built in a profit margin. Okay, so L&T Construction's cost from the vendor's point of view is not this. Okay, this is not the cost from the vendor's point of view, but the price that what will the Delhi Metro put into their NPV calculations? They will, in this C0, they will put in 100 million. Yes. So it is not the cost for the vendor, but it is certainly the cost for the person who is evaluating the project. Because for Delhi Metro, it's like a market. So when I say if I buy a pizza for 200 rupees, that's not the cost for the pizza maker, right? But it is. I can say that the cost of my pizza was 200 rupees, and it's also fair to say that the market price of the pizza for me was 200 rupees. That's the cost I had to shell out to basically, to buy the pizza. Are you following? Okay, so there's a little bit of words are changing and all that, but make sure that you understand, everyone is clear that this is the market price. The C0 that you put into the NPV formula is actually the market price of the project. Everyone is convinced? Gulati, are you convinced?
Sir, I'm trying to understand.
So which part do you don't understand?
Sir, since I'm having a
No, but this part you have understood, that if we say that we are evaluating the cost of extending the metro line to Karnal, let's say $100 million, okay, and these will be the fair value of the project, the returns. What is coming here? All the revenue that the Delhi Metro will get. All these are all the revenues from ticket sales, from advertising sales on the platforms and everywhere else. Okay, all the other franchise, whatever else the source of revenue for Delhi Metro is. Okay, so everything is going to be here. Okay, so this is the fair value component, and the C0. Everyone is familiar with this NPV formula, right?
Yes.
So this C0. I'm forcing you to change the language. Usually we consider this the cost of the project. Okay, I'm saying that the cost of the project for the person who's evaluating the project is the same as the market price of the project, because they're essentially buying the project for this. What are they getting? Once the line is completed, the project is finished. So assume that the line was already completed, and it's a question, it was owned by Reliance, maybe it was owned by like the Airport Express, okay? Maybe it was owned by Reliance, the line was already existing. It's the same thing as instead of getting it constructed for C0, now you're buying it from Reliance at C0. It's the same thing. You're getting hold of the thing for this amount of money. Yeah.
So I have a confusion that how can it be market price of the asset? Because there will be other parameters if we consider it as market price of the asset. Maybe maybe the deal has been negotiated and the price has come down, so it won't be. I mean, it will be an assumption that we are considering it that whatever the market price of the asset was calculated by whoever evaluated it, that is only the initial investment.
No, but what I'm saying is that I'm not 100% clear about your question, but the point is that this cost that you put in is basically from the perspective of the person who is evaluating the project.
Yes.
Is that correct? So this is what they have to pay to get the project on stream or done, basically executed. Okay, we assume that everything in construction everything is done in the first year itself. Okay, in the 0 year itself. So it's almost like, so there are two ways to get a extended network to Karnal. Either the network already exists and it's owned by somebody else and you buy it from them, or you pay a contractor to construct the extension of the line. Right? Both ways, what is happening? This is the amount of money. I should actually be indifferent, because either way I'm getting what I want. I want the line to be extended, I'm getting that, and in both cases I'm having to pay out some money. So whether I get the extended line by buying an existing line or I get a line constructed, it comes to the same thing. Does it not come to the same thing?
So the question is
Yeah, what is the question?
I'll ask after the class.
Yeah, no, maybe if I explain a little bit more, you'll understand. What we are trying to show is here what happens. Now I'll have to cut marks for Pulkit and Puneet. There's too much talking going on now. Normally you were not considered a problem group, but now you have become a problem group. Okay. Any questions or anything, any discussion should be with me, not with between yourselves. Okay, so because we are trying to discuss concepts here, trying to understand how it all fits into the same. So what we are trying to do here is basically clarify some of your conceptual understanding. So if you understand everything as part of a general framework, okay, and a general formula, then it will be much easier for you to remember everything, because you know that is only one general principle that is being applied. So we are now trying to show that this is basically the same as the market price, because what did we say? NPV is also covered under this umbrella. So that means under NPV also the same thing should be working, that if the fair value is more than the market price, then I'll buy the project. And if the fair value is more than the market price, I'll sell the project. Okay, so that kind of similar kind of thinking should come through. Okay, so now we already saw that this is the fair value. Yes, you agree that this is the fair value, and we are only argument that is happening is that we are familiar with this being the cost of the project. I'm saying that the cost of the project, there are two perspectives on cost. One is the vendor's cost, and one is the person who is evaluating the project. Okay, so there is, let's take Delhi L&T and Delhi Metro. Okay, so L&T and DMRC in this example. Okay, DMRC wants to extend the line to Karnal. L&T puts in a bid of $100 million. So what they're saying is, for $100 million, we will get this job done. Okay, so if they don't see the construction, for them it's basically, let's say the construction can be done very quickly. Okay, so for the sake of simplicity, we assume that it can be instantly constructed. They have a prefab line, they just erect it. Okay, so that means what's happening for Delhi Metro's point of view, they are paying $100 million and they're getting the line. The same, I'm paying 200 rupees and getting the pizza. So for me, it's the market price of the pizza is 200 rupees, because what I have to pay to buy anything is the market price, right? Yes. Okay, so what we are saying is the cost has two perspectives. One is the vendor's cost. So 100 million is certainly not the vendor's cost. Most likely not of the vendor's cost, is slightly lower than that. They are building in some profit margin. In extremely competitive bidding situations, you may not build in anything, you may want to get the deal. Okay, but in general, we would expect there's a profit margin built in, so that L&T has some cost of construction is lower than 100 million. Okay, but the 100 million is the cost for the Delhi Metro to get this thing done for DMRC. Right? Yes, everyone is convinced? Don't have to be convinced because I'm saying it with a loud voice. Okay? You have to be convinced conceptually, you have to be clear in your mind that this is the market price, because this is what you have to pay to get the thing done. So imagine that the line was already existing, you would pay 100 million to get the line, get the ownership transferred in your name. Instead of being owned by Reliance, that line is now owned by DMRC. So they're doing the same thing, right? So that is the market price, is what you pay to buy something. Yes, people don't seem very convinced. So I don't want to shove this framework down your Payur. Are you convinced? Are you following? Not very convincing. Expression is not convincing. Okay, maybe if you can think about it a little bit later, but let's think about it. But essentially, this is the market price, because this is what you have to pay to get the job done, to buy an existing line. If you think of this as some existing project where you're just buying. You're buying something. When you typically have heard this expression called asset sales, when you have an asset sale, right? Let's go back to the example of HCL Tech and the buying of the IBM licenses. Okay, we are going to use the same thing. Let's assume that buying of the licenses is like a project. Okay, so here HCL would compute the returns from the licenses. It will basically license out those, basically software. Okay, they'll be licensing out all the software, and every year they'll be earning some revenue from the licenses, right? Okay, and they would discount those revenues and compute the PV of all those revenues. So here, except for this term, the rest of the terms together is the fair value of the licenses, right? And what does HCL have to do to, and how much they have to pay? Let's say they have to pay, say, 200 million to buy those licenses. Okay, so this C0 will be written as 200 million, right? So they will see whether this investment, it's like an investment for them, okay, whether this investment should be made or not. Okay, they will apply the same kind of framework. Okay, they can apply the same kind of framework essentially. Okay, it is quite logical to apply the same framework. They will see whether this investment has how big is the NPV, whether it's positive in the first place, right? So they are paying 200 million. That's the market price of the licenses. Yes, is it a little clearer, Sakshi? Now you are buying it from. So it may not be a market price in the sense that this is a market price. Now we have lost our. There's some problem of. There's a display problem here, I think, somewhere. What is the problem? Anyway, we'll just try to manage for the rest of the class. We have lost the connection as well. Okay, guys, please pay attention. The last bench people are dozing off. Yash, early morning, first period. Okay, so I want to see everybody focused on whatever I'm saying. Okay, if you don't understand it, you have to ask a question, but you should be focused here on what is being taught. Okay, so it's not market price in the sense that the market price of December gold is one for offer price is 1459.50. Not like this, because December Comes gold is actively traded on a platform. Everybody in the world can buy, sell. It's not that sense of market price, but it's a market price. It's still correct to call it a market price because that's what you have to pay to get hold of it, right? Just like the pizza I'm buying is not something, okay, it's available on the platform. Many people can buy it for the same price, so it's not a very good example. But the point is again that it's not like something which is actively traded. Okay, it's still the market price is anything that you have to pay to get hold of the asset, right? In that sense, okay, everyone follows. It's not this sense of the market price. So what are we saying here? So 1 minute. So understand the rule. Why does the same principle always? Why does the same principle still apply? What is the principle? That if market price, this is the principle, right? Why do these rules still apply? What are you doing? Do you accept a project with a negative NPV? If it's a negative NPV, what does that mean? Fair value is less than price. So now that we have anybody has any doubt, please ask, just like Sakshi asked a question. So good. So whenever you have any doubt, you should ask a question. Okay? You should not accept something just because I'm saying with a loud voice, I'm screaming, like sometimes you have teachers who, we had some teachers who didn't really understand the case, but he used to come to class and read the case in a very loud voice. So that would seem like it would be kind of authoritative, and the students would not ask questions because he didn't like questions being asked. So I don't want to do it like that, that if you have any question, you have to ask, okay? Once we have established that this is like the market price, because the person who is evaluating the project, for him the cost of the project is the same as the market price, because what he has to pay to get hold of the project. Okay, yes. So when negative NPV project is rejected, what does that mean? When that means the market price is higher than fair value. Yes, Gulati, are you following this? Negative NPV project means this is more, absolute value of this is more than the sum of all these.
Yes, sir. Yes.
Okay, so negative NPV, that means the sum of all this is the fair value. That means market price is higher than fair value, and you are rejecting it, which means you are following this framework. Rejecting the project is like selling the project. Imagine if the project were actually, imagine that the project, why is it conceptually like selling the project? Imagine that the project was actually being actively traded, like on a platform like this. If the project was actually being traded and it had a market price of something which you felt was too high compared to the fair value, okay, then you would sell it, because what do you believe if you are in this box? If you are in this box, what do you believe? That the market price must eventually come to fair value. So that's why when you see anything above the fair value, you sell it. Sometimes it may not be possible to sell it, but conceptually the idea is the same. Like in Indian equities, you have seen it difficult to do short selling because the system is not well developed. Okay, but conceptually you know what short sell, in what situation you would want to short sell. Is this clear? Are you following what I'm saying? Okay, now we have to cut for Bharat and Ganotra also. There's a lot of talking.
So
Yes, sir.
almost over, sir.
Class is over when I say it's over. You don't decide when the class is over.
Yes, sir.
1 minute. So I didn't know that the class was over, but anyway, that's a different thing. So our class monitor, the class termination monitor is over there, no? When he starts getting restless, then we know the class is over. Okay, 1 minute. Okay, so we have had a long discussion. We didn't really manage to cover much ground, but I hope you guys understood what was being discussed. Okay, so try to go and fit the NPV. We'll continue with that. We are losing a lot of time, but these are important concepts. Okay, guys, you can go now. But you guys will lose your points. We need to crack down on this. Too much talking going on actually. SG1 is very happy.